Right now, banks across America are sitting on $620 billion in losses that most depositors don't know about. These aren't losses they've reported. These are hidden losses sitting on their balance sheets, waiting. And if you have money in a bank, especially a regional bank, you need to understand what these losses are, which banks have them, and whether your deposits are actually safe. In this video, I'm going to show you exactly what's happening, why banks can legally hide these losses, and how to check if your bank is one of the risky ones. Value proposition. By the end of this video, you'll understand what unrealized losses are in simple terms, which types of banks are most exposed, and the practical steps you can take to verify your bank's safety. Let's break it down. What are unrealized losses? First, let me explain what unrealized losses are in the simplest way possible. When you deposit money in a bank, the bank doesn't just let it sit there. They invest it, mostly in treasury bonds and other safe securities. Here's how it normally works. The bank buys a treasury bond that pays, say, 2% interest. They plan to hold it for 10 years. As long as they hold it to maturity, they get their money back plus interest. No problem. But here's what changed in 2022 and 2023. The Federal Reserve raised interest rates dramatically. When rates go up, the value of existing bonds goes down. So that bond the bank bought at 2%, it's now worth less than they paid for it. If they had to sell it today, they'd lose money. That loss, the difference between what they paid and what it's worth today, is called an unrealized loss. It's unrealized because as long as the bank doesn't sell the bond, they don't have to recognize the loss. It just sits there on the balance sheet, hidden. And right now, banks are sitting on $620 billion of these hidden losses. Why this matters? You might be thinking, if they don't have to sell the bonds, what's the problem? The problem is, what happens if depositors want their money back? Here's the scenario. If a bank experiences a run, if a lot of depositors try to withdraw their money at once, the bank might need cash fast. And to get cash, they'd have to sell those bonds at a loss. This is exactly what happened to Silicon Valley Bank in 2023. They had billions in unrealized losses. When depositors got nervous and started withdrawing money, the bank had to sell bonds at a loss to cover withdrawals. The losses became real. The bank failed. First Republic Bank, same story. Signature Bank, same story. The unrealized losses became realized losses. The banks collapsed. And right now, there are banks sitting on massive unrealized losses that could face the same problem if depositors get nervous. The $620 billion in unrealized losses across the banking system means there are banks out there that look healthy on paper, but could be in serious trouble if they face stress. Which banks are most at risk? Not all banks are equally at risk. Let me tell you which ones to watch. Regional banks. Regional banks, the smaller banks that operate in specific states or regions, tend to have the highest concentration of unrealized losses relative to their size. Why? Because they put a larger percentage of their deposits into bonds. When interest rates rose, they got hit harder. Banks with heavy commercial real estate exposure. Banks that lent heavily to commercial real estate are also at higher risk. Office buildings are struggling because of remote work. If those loans go bad at the same time the bank has unrealized bond losses, that's a dangerous combination. Banks with high uninsured deposits. If a large percentage of a bank's deposits are above the FDIC insurance limit of $250,000 per account, those depositors are more likely to pull their money out at the first sign of trouble. That creates run risk. The big banks are safer. The largest banks, JP Morgan, Bank of America, Wells Fargo, Citibank, have unrealized losses too, but they're much larger institutions with more diversified funding sources. They're less vulnerable to runs. So if you're at a regional bank with heavy commercial real estate exposure and a lot of uninsured deposits, that's where the risk is highest. Is your money safe? FDIC coverage. Let's talk about FDIC insurance because this is what protects most depositors. FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. What does that mean? If you have $250,000 or less in a checking account, a savings account, or a CD at one bank, you're fully protected. If the bank fails, the FDIC guarantees you'll get your money back. But if you have more than $250,000 at a single bank, the excess is not insured. If the bank fails, you could lose that money. This is why Silicon Valley Bank was so vulnerable. A huge percentage of their deposits were from tech startups and venture capital firms with millions of dollars in their accounts, way above the FDIC limit. When those depositors got nervous, they pulled their money out and the bank collapsed. So the first question you need to ask, do I have more than $250,000 at a single bank? If yes, you need to think about spreading your deposits across multiple banks to stay within FDIC limits at each one. How to check your bank's health. So how do you actually check if your bank is one of the risky ones? Here are 3 things you can do. Check your bank's financial statements. Banks are required to report their unrealized losses in their quarterly financial statements. You can find these on the FDIC website or the bank's investor relations page. Look for the line item called Unrealized Losses on Securities, or Held to Maturity Securities. If the unrealized losses are large relative to the bank's capital, that's a warning sign. Check the bank's Texas ratio. The Texas ratio is a quick measure of bank health. It's calculated as non-performing loans divided by tangible equity plus loan loss reserves. A ratio above 50% suggests stress. Above 100% suggests serious problems. You can find Texas ratios for most banks on financial websites like Bankrate or banking industry databases. Look at the bank's CRE exposure check. How much of the bank's loan portfolio is in commercial real estate? If it's more than 300% of the bank's capital, that's considered high exposure by regulators. These 3 checks will give you a good sense of whether your bank is in a risky position. Disclaimer: this is educational analysis of banking sector risks and deposit safety, not financial advice. Call to action. Banks are sitting on $620 billion in unrealized losses. Some banks are more exposed than others. And if you're at a regional bank with heavy commercial real estate exposure, you need to understand the risk. FDIC insurance protects deposits up to $250,000 per account. If you have more than that at one bank, consider diversifying. If you want updates on banking sector risks and financial stability indicators, subscribe. Is your money at a big bank or a regional bank? Outro. Thanks for watching. Check out the video on screen about the 2008 pattern, another banking crisis warning signal. I'll see you in the next one.